Trump's One Big Beautiful Bill was just signed into law, and it's being claimed that there are no more taxes on Social Security benefits. But I'm here to tell you why that's not exactly true, and I'm going to provide some examples to show you how these new changes might affect your retirement. And if you're new here, welcome. My name is Jacob Duke. I'm a certified financial planner and the owner of a retirement planning firm where we help people just like you plan smarter so you can retire better. Now, before we get into how Social Security taxation will be impacted by this bill, let's quickly cover some of the changes that impact pretty much everyone. The major objective of this bill was to extend Trump's Tax Cuts and Jobs Act that began back in 2018 and was set to expire at the end of this year, being 2025. The TCJA lowered the marginal tax rates across the board, and the objective of this new legislation was to make those tax cuts permanent, which has now happened. So the 10, 12, 22, 24, 32, 35, and 37% brackets, those are going to remain at those levels, and they will not go up in 2026 thanks to this bill becoming law. Now, in addition to that, the TCJA also raised the standard deduction dramatically back in 2018, and that higher standard deduction that we've all gotten used to, it's going to be permanent as well. And on top of making the higher standard deductions permanent, the One Big Beautiful Bill actually increases this year's standard deduction by $750 per person. So when we started in 2025, we all believed that this year's standard deduction would be $15,000 for single filers and $30,000 for married filing jointly, but now it will be $15,750 for single filers and $31,500 married filing jointly. Now, this means that the resource that I use with my clients every single day that you can see here is now incorrect. And since I've shared this resource with many of you, just know that what I previously sent you, that's now incorrect for 2025, and that your standard deduction is actually higher this year. Now, since this video is not so much meant to cover the entirety of the One Big Beautiful Bill, I won't spend any time on things like no tax on tips or no tax on overtime or SALT deduction cap increases or other important changes. I want to focus on the Social Security taxation and show you why your benefits are going to remain taxable just like they always have been, but a new extra deduction for seniors, that's what I'll call it, that can help you reduce your taxes on your Social Security benefits. The reason for this being an extra deduction for seniors is because seniors that are 65 or older are blind are already receiving an extra deduction of $2,000 for single filers or $3,200 for married filing jointly. And these current extra deductions are added on top of the standard deduction if you are 65 or blind. But now there's another deduction even on top of that one that seniors can use if they qualify. It's an additional $6,000 per person or $12,000 for married filing jointly tax filers. And the key here is that this isn't increasing or replacing that current extra deduction for seniors that you're already getting. That one is staying in place exactly like it is, and this new one is getting added on top of the one that already exists. Now, this ends up being a substantial amount of money that can be excluded from your income, and what's unique about this $6,000 deduction for seniors is that you can use it whether you itemize or use your standard deduction on your tax return. But that extra deduction doesn't come without its drawbacks, because it's important to know that this extra deduction for seniors is not permanent and will only be available through the end of 2028. And what's more is that not everyone can even use it. There are income restrictions being put in place to determine who is eligible for this new deduction. So you're probably wondering who actually qualifies. It's going to be individuals with income of up to $75,000 or $150,000 married filing jointly. And I'm just going to assume that that's counting your, or talking about your AGI there. So if you're under those income amounts, you can use the full $6,000 per person deduction if you're 65 or older. But if your income is higher than those amounts, your deduction amount will be decreased. And if your income for single filers exceeds $175,000 or $250,000 for married filing jointly, you will be completely phased out and not eligible for that $6,000 deduction. If your income is somewhere between those two amounts, you would get some sort of deduction, but it's just going to be reduced from the $6,000 amount because you're in the phase out range. So that's what we currently know about this extra deduction for seniors. And it's because of this particular deduction being added that it's being claimed that there is no more tax on Social Security, but that's not exactly true. And I'm about to show you why. So right here, you can see a summary of what we have covered so far. For single filers, you can see that we have the standard deduction, which is normal, right? But we also added that $750 in for 2025. So $15,750 is the new standard deduction for single filers, corresponding there for married seniors. So again, you've got standard deduction up to $31,500. Now, the existing senior standard deduction, which I mentioned mentioned earlier for single filers is $2,000. That's staying in place. It's not increasing. It's not going anywhere. It's also being made permanent through this one big beautiful bill. In addition to that, the married filing jointly side of that, instead of $2,000, you get $3,200. So normally, if you're 65 or older, you would get those two things, those two items in combination with each other. Now, this additional, what I'm calling the extra deduction for seniors, this is going to be that $6,000 for single filers and then $6,000 each, so $12,000 for married filing jointly. So if you're 65 or older and you're claiming standard deductions and you're doing all of this and you're under the income limits as described just a moment ago, here is your new standard deduction for single filers. And here is your new standard deduction for married filing jointly. Now that's a pretty big increase, right? So additional $6,000 for single filers and $12,000 plus the slight increase there on the normal standard deduction. You've got a pretty good sum of money that you can earn without paying any taxes or even have it being taxable at all. Now, what I want to do is focus next on this piece right here. So this is what is being kind of formulated as the idea around no tax on Social Security, at least from the Trump's team, their perspective and how they're kind of talking about this. So let's just read this really quickly together. First, consider the case of a senior filing as a single taxpayer receiving the current average retirement benefit of approximately $24,000 per year. So they're saying that the average Social Security benefit is $24,000 every single year for a single person. The maximum amount of Social Security included in the taxable income is 85% of that benefit. It is true that up to 85% of your benefits are subject to taxation at any given point, but here's the thing, none of your benefits are subject to taxation if your only income or source of income is Social Security. And I've talked about this at length and kind of gone through examples explaining exactly how Social Security income taxes work. And so if you want to watch a video on that, I'll have it linked down in the description below for you to go check out after this one to get a lot more detail and really understand how Social Security taxation really works in a nutshell. So that is accurate, which would mean that $20,400 of the $24,000 is the actual taxable amount of Social Security in this case. Now, what they're saying is because of these new standard deduction, all the extras added on under the one big beautiful bill, the new deduction amount will be $23,750, which is greater than the $20,400 that's there. So that is also accurate, and this would, I guess, in some sense, make all of your Social Security completely tax-free. Now, here's what I'll say. Is you don't need the extra standard deductions or the extra things added on for all of your Social Security benefits to be completely tax-free if, again, only source of income is Social Security. I'm about to explain to you why. So let's go back and let's say that, again, we're going to use that $24,000 just as an example right now to kind of stay on the same page. Let's say you're a single tax filer and let's just say you're not even 65. Let's say you're under 65 to take off this additional $2,000 there. So we're not even going to use that extra standard deduction for seniors. So $24,000 is your Social Security amount, okay? Now, whenever we do this, I'm not gonna go through the complete explanation here and explain it in detail because, you can watch that video, but in order to calculate how much Social Security is actually taxable, we've gotta find what's called a provisional income or a combined income and then run it through the combined or provisional income brackets, which I'll show you in just a moment. And then we can determine how much of it's taxable, and then we go back and calculate our taxes. So it's kind of a multi-step process, but the first thing to do is to find the provisional income. And the way to do that is to take 1/2 or 50% of your Social Security benefits, whether you're single or married filing jointly, doesn't really matter. Take half of however much you've collected and then add in any other income. So IRA distributions, pensions, earned income, add your other sources of income that are taxable to that 1/2 of your benefits. And then you'd also add in any tax-free interest, maybe from like municipal bonds. That actually has to be added back here, even though you won't be taxed on it, it has to be factored into your provisional income calculation. So in this case, let's just assume we have no other income. We're earning the average benefit. So we're getting $24,000 of Social Security and no other taxable income. So what would happen here is we take 1/2 of this amount right there, that equals $12,000. Okay, and then what we would do is we take that $12,000, that's our provisional income in this scenario. I'm going to change it just a moment to give you even more context, but $12,000, that is the provisional income. And right up here, you can see the provisional income tax brackets. Okay, so we're going to focus on the single side because that's what we're looking at right now, but the same thing, it works the same way for married filing jointly, just at different amounts. So if you look at this, the first $25,000 of your provisional income, which again, that's that $12,000 number we just discovered. So if you have $25,000 of provisional income or less, none of the dollars in that particular bracket are taxable. You see that there, 0% are taxable. Any dollars that are above that in the range of $25,000 to $34,000, 50% of the dollars that fall in that range are subject to taxation. And then anything that is above $34,000 of the provisional income, 85% of the dollars above $34,000 are subject to taxation. So I'll show you an example again of how to really work this in a moment, because it doesn't apply just yet with this small of a provisional income. But that's how that works in terms of running this through the bracket. So if we've got $12,000 here, a provisional income, we know that that first bracket is all the way up to 25,000, which means that's less than 25,000. So none of our $24,000 of benefits are subject to taxation. Now, here's the thing. We didn't even have to go find a standard deduction. We didn't have to go get an extra deduction or this extra $6,000 deduction for none of our benefits to be taxable. So that's my first kind of thing about this is just because you had $24,000, which is the average benefit for the average American, just because you had that in Social Security doesn't mean that you need these additional deductions to even have no tax on your benefits, because 85% is the maximum amount of your benefits that would ever be subject to taxation. It's not what's always subject to taxation, which is kind of being maybe misconstrued here in this explanation. So this $20,400 number doesn't even apply if the only source of income in this scenario that they're describing is the Social Security income. Now, let's change it really quick. Let's keep $24,000 as the standard, as the benefit the same for now, and I'm going to show you how to run this through with other income. So let's say that we've got $24,000. I'm going to kind of take this out here. And what we're going to do is we're going to say we also have $40,000 of an IRA distribution, okay? So this is going to change the game quite a bit, and you'll see as we go through. So now we have a total of $64,000, but the first thing we have to do is find our provisional income. So what do? We take 1/2 of the Social Security amount, and we take all of this $40,000 right here. So that would be $12,000 for the Social Security side, and then $40,000 there, so that equals $52,000. That is our new provisional income. Okay, so $52K is our provisional income. Now what we do is take that, run that through the provisional income tax brackets again, but you're going to find that a portion of our Social Security benefits are now going to be taxable. So let's take a look at that. So $52,000, we know that the first bracket is $25,000 right there. So the way I do this is I take $25,000 and subtract that out. Okay, so that equals 47. So 27 is left over. That means that 0% of that 25 is actually subject to taxation. Okay, that's the first thing. Now the next bracket is from $25,000 to $34. That's $9,000 total. So what we do is we take $9K out of this, and what does that equal? What is that? 18. Yeah, it's 18. And then we have that. So 50% of that 9 that's in the range of that 25 to 34, 50% of that amount is subject to taxation. So that means $4,500, okay? And this $18,000 left over, this is the amount that is actually going to fall in this 34,000 or greater range. So that means 85% of this amount, whatever it comes out to be, in this case it's 18,000, 85% of that is subject to taxation. So what I'm gonna do is a quick calculation here, and that comes out to $15,300. So what we've got is $0 are taxable at this level right here. We've got $4,500 taxable at this level, and we got $15,300 taxable at this level. So now what we do is we take the sum of all of this, and what this comes out to is 48, 19,800, right? So 19,800. Okay. This is our new taxable amount of Social Security. So what we've got here is $19,800. Now here's the thing. We got $24,000 as our actual benefits that we received as a gross amount from Social Security. So that's our benefit, $24,000. Only $19,800 is subject to taxation. Now, here's the thing. That might end up being higher than 85%. So once we go through this calculation, if it's less than 85%, great, that's what it's going to be. If it's more than 85%, guess what? You get the lower of that or 85%. So what I'm going to do is I'm going to take this $19,800. I'm going to divide that by 24,000 to see if it's above or below 85%. And it's only 82.5%. So here's the thing. So we're still not maxed out in terms of 85% of 24,000. So really this is 82.5% of your benefits are being taxable. So what's happening here is this. Now we take this $19,800, we take that amount and we add it to this $40,000, and that is your adjusted gross income. That is your new AGI. It's not the total of these two before you go through this provisional income process that I've gone through. You'd go through the process first, and that determines what your true AGI is. So if we say that it's $19,800 plus $40,000, that comes out to just under 60 grand, and that is 59 $16,800. So now what would happen is you would take this adjusted gross income and then you would apply your standard deductions. So what we're going to do is we're going to say that $23,750 as a single filer, we're above 65 and we qualify for these things because our income is not too high, right? We're still below those income restrictions of 75,000 for single filers as an AGI. We're still below that, so we qualify for the 6,000 and we're still getting the normal 2 and we're getting the slightly increased standard deduction. It comes out to 23,750. So what we do this time is we take that away. So 23,750, and this all happens on your tax return. I'm just showing you what actually goes on here. We're left with $50 here, and we've got 6 and 3. So $36,050 is what's called your taxable income. You had your AGI, we're subtracting out the standard deduction. Now we have our taxable income of this amount. At this point, we'd run this through the normal income tax brackets for a single filer. You can see here on screen, the 10% bracket is up to almost 12,000, it's 11,925, and then it flows into the 12% tax bracket there. Not gonna do the calculation on that to show you how much of that actually comes out to in taxes. But to argue that the increase in the $6,000 deduction and the increased deductions overall does help eliminate tax on Social Security, it's partially true. And here's what I want to show you. So $19,800, that was our taxable amount of Social Security, right? Our standard deduction, though, we used was $23,750. So in this scenario, even with $40,000 of additional income, guess what? $23,750 is higher than $19,800. So you can argue that the standard deduction is offsetting or eliminating taxes on those Social Security benefits. That's one way of viewing it. Now, what I'm going to say is this: that's not completely true, and here's why. Because this $19,800, that's actually being included in your AGI still, which is pushing more of your IRA dollars that you have as income from a distribution, pushing that into tax brackets, and you're not getting to use your standard deduction to offset it completely. So actually, I lied. I'm going to go back and I'm going to calculate taxes on this $36,050, okay? And then I'm going to show you what it would be if Social Security was not taxable at all in terms of what is even factored in. So 36,050, what I'm going to do here is 36,050 minus 11925. That's the first level there at 10%, 11925. And that's at 10%. And so what we get is a leftover of 24,125. All of that fits within the 12% tax bracket. So if we do a little bit of math here, times 0.12, and this, by the way, is only for federal. I'm not including any state taxes here just because it's impossible to do that. We can see we've got 11, I'm just going to call it 92 to keep it simple. So we add 1192 to this number. So your total tax bill is 4,087. Okay, so 4,087, going through the scenario we just went through, that's how much tax you're going to pay in order to get a total of, what was this, $64,000 of total gross income. So 64,000 there. So if we divide that by 64,000, you're at a total effective tax rate of 6.38%. That is your total tax paid right there, and that is your effective tax rate on every dollar on the 64,000. So we'll keep those two numbers in mind. Now back to the point of why we can't say necessarily or exactly that the standard deduction makes none of your Social Security taxable, because what it does is yes, technically standard deduction is higher than how much is taxable in this scenario, but your other income is getting pushed at higher brackets. So if we just said that there was no tax on Social Security at all, we would not have to include this 24,000 or this 12,000 anywhere in our calculations. All we would do is we would take this $40,000 right here, and we would take that and use the standard deduction against it. So if we just did that, just to show you really quickly, so 40,000. And if we use this standard deduction, right, of 23,750, if we use that like we just did in the last one, that equals 16,250. That is our new taxable income. So do you see the difference there? Taxable income before was what? $59,800. Taxable income now, if Social Security was completely just not even factored into taxes at all, only 16,250. Now what we do is I'll erase this piece here, and I'll get that, and then we'll say that the standard deduction was 11925. So that equals 4,325. So this amount here is at 10%. This amount here is at 12%. And so what we can say is 0.12 times 4,325 plus 1,192 equals a total tax of 1,711. That's the new tax, assuming you still get your $64,000 of total income, and this is under the assumption that none of your benefits were subject to taxation at all, and your only income was at $40,000 of IRA distribution. So you can see the difference there. You're paying over $2,000 less in taxes, and as an effective rate on 64, you're at we'll call it 2.7% effective tax rate. So that's why, in my personal opinion, we're not eliminating taxes on Social Security for anyone. We're simply increasing standard deductions, and we're basically helping people have less tax to pay. It is helpful, absolutely, but we can't claim, in my opinion, that Social Security is not being taxed at all. Even if the standard deduction is higher than how much of your benefits are subject to taxation, you're still pushing more of your other income into higher tax brackets. So again, you can see all of that $40,000 or almost all of it, or actually all of it, is at perhaps the 12% rate compared to none of it being, or very little of it being at the 12% rate with no Social Security being factored in at all. So hopefully this gives you a couple things. Number one, it shows you exactly what's going on in this new tax law that's been signed and is now in place. And then also two, it shows you more about how Social Security taxation works. And if you want more detail on this, or I guess a more specific in-depth explanation, again, go watch that video. Hopefully this helps. If it was, please share it with a friend. Please share it with someone you know that could benefit from it as well. And if you're new here, please subscribe. That way you don't miss any future content or videos around retirement planning. Thanks so much, and we will see you in the next one.